What's going on in the market this week? Rates have been steadily rising. Not a whole lot to talk about from last week, but we do have some developments. Let's look at rates real quick. So conventional loans about 7.1%. Government loans are about 6.7%. But to get these rates, you're looking at excellent credit with a larger than average down payment. If you don't have excellent credit or a large down payment, no worries, we can help. Click on the link in the description to get in touch. Even if you're not ready to purchase, we can talk about what that looks like for you. The earlier the better, so that way you can work on the things that you need to work on. Like we said last week, inflation reports have been a little disappointing, showing an upward trend. We're hoping that this is just a little bit of a speed bump and that inflation will continue to lower. We just don't know yet. We're going to see some of that data come out later this week. So for now, rates are up a bit. On Thursday, we're getting the PCE report. This is the Personal Consumption Expenditures report, and this is the Fed's favorite metric to gauge inflation. January CPI report, the Consumer Price Index, and the PPI report, the Producer Price Index, those weren't good reports. So let's see what the PCE report is going to have for us. Early gross domestic product numbers are showing that the economy is softening. This report is not final. We'll have the final numbers to the end of Q4 for 2023. Those will come out next month. Consumer confidence for February did decline, and we're seeing that in the labor market. Macy's announced that they're closing 150 stores nationwide that have been underperforming. Now, all of this data about rates, all of that can change if unemployment starts to rise. If unemployment numbers start to rise, the Fed's going to have to do something about interest rates, and that's when we may see cuts. Mortgage applications were down for February. I think it had a lot to do with rising home prices, higher interest rates, and a lower amount of homes on the market. If you're looking to buy this year and this is a concern to you, I talk to people all the time who are saying, man, I wish I would have bought last year. I wish I would have bought the year before that, or even 4 years ago. But I've been waiting for home prices to go down. The data showing us that home prices are not going to go down at all, at least in our market. They may be for some parts of the country, but definitely not our area. So let's go back. Let's go way, way back to 1942. That was 81 years ago. Out of those 81 years, home prices have increased 75 times. So 75 years out of 81, home prices have increased every year. But 5 of those 6 years were through 2007 and through 2011, and we saw there was a major crisis in the housing and mortgage industry. That crisis was caused by a bad mortgage process that caused people to lose their homes nationwide. Since then, the Dodd-Frank Act of 2011 regulated mortgage lending so that people could not get into homes that they couldn't afford. So let's talk about where we are right now. We have a low housing inventory, and new construction cannot find enough deals to invest in to keep up with the demand. So that means we have a different housing crisis, a very high demand on homes, which will increase prices. For example, Zillow said last year that there was going to be a drop in home prices, and they just revised that data to say that there's going to be a 4.2% increase instead of a decrease. That's huge. So let's just say if today was 2008, and it's not, it's a very different market because people have more equity. Let's just say there were mortgage defaults like there was in 2008. If people were defaulting on their loans, we have the highest amount of equity. With equity, they can sell for a profit instead of short sale or even be in a foreclosure situation. So I'm basically talking about the North Carolina area. There are some markets like in Idaho and California, they're seeing a decrease in their markets. So what does this mean for you? This means to buy as soon as you're ready. How do you know if you're ready? That is the 4 pillars of a mortgage, which are credit, debts, income, and cash to close. If you have those 4 things together, you're ready to purchase in any market. We are eager to see what the PCE report is going to look like, and we'll break that down for you. Hope you all have a great day, and we'll see you next week.